All right, guys, Intel and Visa just reported. Intel, awful news. They were expected to earn 20 cents a share. They earned 10 cents per share. They were expected to get $14.5 billion in revenue. They did 14.04. They were expected to hope for $13.5 billion in revenue in the first quarter. They're now guiding for 10.5 to 11.5. This is ugly. This is a play that I had that has not worked out very well at all. Now, is Intel reinvesting a lot? As I've said before, it's a long-term multi-year play. Absolutely, but it's not going to be pretty for a while. The PC industry is lagging. It's not doing well. There are a lot of chip makers that are doing very, very well here. So you have to decide for yourself what's important to you. The short term looks ugly on Intel. Absolutely ugly. Absolutely ugly. The stock is currently down 5.5% after hours. Now, if you like this kind of discussion, we do all of these videos, we do earnings releases all the time. It's literally 4:11 p.m. Eastern time. You're probably going to watch this in the next 30 or 45 minutes because it'll be posted then. Follow our channel. You're going to learn a lot. You're going to walk away having a better understanding of investing in money. 2, share this video with 3 or 4 people you know that might be interested in Intel or Visa. And we'll go to Visa now. Visa crushed it. They reported $2.18 per share in profit when they were expected to do $2.01, and they reported $7.9 billion in revenue when expectations were 7.7%. They were obviously helped a lot about with, inflation, because inflation drives up prices. If people swipe that credit card, revenue is going to be higher and higher. Visa is a great company, high margin, high return on invested capital. But here's what I want you guys to remember about some of these companies. This is Intel's chart going back to 1987. This was 2000. They have not reached their peak of 2000. But here's the interesting thing. Let's go. Now they're down 5.85%. So, back in 2000, did $33 billion in revenue. This last year, they did $69 billion. Back in 2000, they made $10 billion in profit. I think it was kind of a fluke year. This last year, they did 13.3, but before then, they were doing 20. So double revenue, double profit, and the stock was still down from its all-time high. Why? Stocks are a voting machine in the short run and a weighing machine in the long run. If you overpay for a company, if you overpay for a stream of future cash flows, it's going to hurt you in the long run. People overpaid here. If I told you back here when Intel was at $75 a share, its all-time high was August 28, 2000 at $75.81. If I told you here, in the next 20 years, Intel's revenue and profit would double, where would you have thought the stock would go? Would you have thought it'd be selling for less than half? Of course not. And that's the point. That's what I want you to take away from this video if you're new to our channel. If you're not new to the channel, repeat this over and over in your head. And this is not the only example of this. Micron, Cisco, Intel, a lot of great companies. I believe Tesla will be like that in the future. I believe that the all-time high of Tesla of 414, and if it does see a new high soon, it'll be a long time before it reaches those highs again. Because every investment is the present value of all future cash flow. And that's the weighing machine over a long period of time. All right. Now, Intel, here are the analyst estimates for Intel. It's going to be ugly, guys. But look at the profit, supposed to double in the next 2 or 3 years. And revenue is probably going to struggle here. They only have 1 year of revenue estimates because of the fact that, and look, their revenue is supposed to go from $70 billion in the last 12 months down to $62 billion this year. It's a big drop. They're trying to turn things around. If you believe in Intel as a long-term play, be ready for a bumpy ride. But just like Tesla being down almost 75%, even though their sales are getting better and better, it's still down like 60% right now. Eventually, there'll be a stop. As long as Intel stays in business, and as long as it's able to grow revenue and profit from today, it'll eventually stop going down in price. The question is when. We have no idea. I hope I'm not wrong on Intel. But if I end up being wrong, I end up being wrong. That's why you take these value plays and you do several of them to get a feel for it all. Okay, let's go to Visa here. Well, let's actually look at our 8 pillars for Intel. 8 pillars for Intel, $27 billion drop in free cash flow. They're spending a lot of money on their free cash flow. Net income has dropped, and their revenue over the last 5 years is actually up, but not by much. That's probably going to go down here pretty shortly. They got a decent 5-year return on invested capital, though. So there are some positives, but there are some negatives. Look at this 5-year PE, 6.7. this could be a value play, or it could be what people call a value trap. I consider a value trap just being wrong. I don't believe there's such a thing as a value trap. You're either right or you're wrong. And if you're wrong, you're wrong. And I'm hoping to be right about half the time. So if I'm wrong here, hopefully I'm not, but it very well could be the case. It's going to be a tough play. It's going to be a tough road going forward. Now, Visa. Let us check out Visa. Look at Visa. It is up 1.5% after hours. I already reported the numbers. A couple things on Visa that I like. Market cap, $475 billion. Enterprise value, $510. The difference in between is debt. Not a ton of debt. Free cash flow in the last year, $18 billion. Last 5-year average, $13 billion. And they pay out about $3 billion in dividends. Oh, speaking of dividends, Intel has a very healthy dividend. Be careful. I would not rely on that dividend. They're spending a lot of money on free cash flow. That dividend might be something they take away to save for the money for the company. I'm not safe. I'm not secure on Intel's dividend. I'm not saying it's going to go away, but as they spend more and more money to grow the company, it has to come from somewhere. All right, back to Visa. Look at this gross margin on Visa. 80.4%. That means every extra dollar that comes into the business as revenue, 80 cents of it goes to pay taxes and overhead. And their leftover after tax and overhead is about 50%. This is a very high margin business. Look at this return on invested capital, 19%. Visa deserves a premium to valuations. High gross margin, high bottom line margin, high return on invested capital, amazing moat. If I were to ask you right now, what's the number one credit card charge in the world? Everybody would say Visa. The only reason you'd say American Express is if you're talking about the customer service and exclusivity. But other than that, the number one is Visa. It is Visa. So the question becomes, are you going to pay too much for Visa? Because look at this. The PE is 32. The 5-year PE is 39. Guys, it's possible to pay more. It's possible to overpay for a good thing. So the question is this too much for Visa? I have no idea. Let's check out the 8 pillars for Visa. All right, everything's a check mark except for 5-year PE and 5-year price of free cash flow. Buying back some shares. Don't necessarily. I don't like. If you're new to the channel, I don't like people buying back expensive shares. That bothers me. You're using your capital that you have as a shareholder. You have a right to that capital, and they're allocating it to buying back expensive shares. It's no different than overpaying for an acquisition or another stock. Good cash flow growth. Good net income growth, good revenue growth. And as the world gets larger and larger and more wealthy, more and more people will use Visa. Visa is one of my companies I want to own for the long run. I don't own it currently. And before you go buy it, make sure you do your research. And when I do buy it someday, still do your research because I could be wrong. And I'm able to make purchases at a lot different price than everybody else just due to my outlook on things. Now, let's check out the analyst estimates on, all right, for the next 4 years, $8.45 a share this year, $15 a share in the next 3 or 4 years. Even at 20 times, that's still a price of $300 a share. And the stock is currently at $228. Not a lot of upside there. That already tells me maybe it's a little expensive. And revenue growth, yeah, I mean, it's going to keep growing, but it'll probably be at a slower pace, except for the fact that inflation is going to be there, growth's going to be there, et cetera. So I don't necessarily agree with these low revenue growth numbers, but we'll see. Now, we're going to do the stock analyzer tool for this software. Now, guys, if you're new to the channel, this stock analyzer tool was used 1.3 million times by our users last year. Our users are here in this community. If you have an interest in getting all this software, plus tons of tools you didn't even see us use, check out everythingmoney.com. For less than a cup of coffee per day, you can have this. You can have access to thousands of people in the community talking about their investment ideas, because the hardest part about investing is going against the crowd. This crowd believes going against the masses. They're going to have that right mentality. And being mentally strong is the most important part about investing. Look at Intel. Intel's down. It's down in the dumps. Okay. And I have money invested in Intel, and I'm down a lot of money. Okay. What do I do about it? When Paul 15 years ago, oh my God, what am I doing? I'm wrong. I'm all antsy. And we've all been there. But once you understand the fundamentals, and once you're around people who you talk to that are similar, there you go. It's going to make it a lot easier. So I'm going to do a 20-year analysis on, now let's do a 10-year analysis on Intel, on Visa. So my goal here is to do low, middle, and high revenue growth, profit margin, free cash flow margin, then apply a ending PE and price of free cash flow, and then tell the software, here's how much money I want to make, my desired return. That desired return should be enough to give you some margin of safety. So as you make higher and higher assumptions, put a higher return. That way you get more and more margin of safety, right? The higher the desired return, the less you pay for the stock, which is more margin of safety. And margin of safety is the most important thing because you're going to be wrong on things. All right. So revenue growth. I'm going to do 4, 7, and 10% for the next 10 years. Profit margin. I mean, they're pretty consistently doing this number. So I'm going to do, let's go a little bit lower, 45, 48, 51. Free cash flow margin. 48, 52, and 56. PE. Now, guys, I believe this company deserves a lot of a premium. So I'm putting the lowest number of the historical value of PEs, which is 15, and the historical value of price to free cash flow. But as the assumptions get higher, I want a higher return. But I do believe the company should also get a higher multiple as it does better. So that's why I'm doing 15 times, 17 times, and 19 times on this. If that sounds confusing for you, we've done over 2,000 videos, and well over 1,000 of them are in individual stocks. Please go watch 4 or 5 of them. It'll make more sense to you over time. This was confusing to me when I first started. But the bottom line is, every investment's the present value of all future cash flow. My goal is just to make assumptions about that cash flow and apply a multiple of that cash flow for the value of the business. And this will spit out exactly what my assumptions and desired return will tell me to pay for the stock today to get those returns. Let the software do it for you. It's going to make your life a lot easier than making Excel sheets, guessing, etc. Have the software do it for you. Now for my desired return. I go back and forth on this. I think these numbers are very conservative. And you can get 9 or 10% by investing in a long-term ETF. But I do think the next 10 years are not going to be pretty. So you have to ask yourself, is 10% enough? Do you want 12%? Do you want 8%? This is a conversation I had with somebody in our community today. He said, Paul, if stocks go nowhere for the next 10 years, like valuations show, should I be okay with 10%? Sure, if you want. That's the art of investing. It's about what you want for the company. And that's the key here. So I'm going to do 10, 13, and 16%. Hit the analyze button. The stock's currently at 228 on the nose. The number's going to pop up. I'm going to have it on my watch list. I currently have it on my watch list at 120. I have a low price of 100, a high price of 130 to 145, and a middle price of 120. So really, guys, this 120 price seems about right. I have it on my watch list. I just added it right there. I'm actually going to make it 125. 125, notify me. It'll notify me through email, through my phone app, and through the desktop and tell me Visa hit your price. So guys, again, 3 things I need you to do. Subscribe to the channel, share this video with any friends of yours who might like this process or are looking at these 2 stocks. And 3, check out everythingmoney.com to get software that'll make your life easier, because the more you learn, the less you fear. Thank you very much. Imagine how good it'll feel to see markets falling and not have a worry in the world. Imagine how good it'd feel to have financial peace of mind. Imagine how great it'll feel to be able to understand how to read financial statements and impress all your friends when you're able to buy stocks based on facts and not emotions like they do. This is exactly what our software will help you learn and understand. For a little over $1 a day, you can have access to the same exact software that I use in our videos and that I use every single day for my own private investment decisions. It is beyond easy to use. And if you don't like it in the first 30 days, email us, 100% money back guarantee, no questions asked. Stop worrying about your retirement and future and start planning for it. So begin right now at everythingmoney.com and start planning for your future confidently today, right here, right now.